Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
It is a Friday morning finally, and you're with us on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. There are two of us here in the studio, so good morning.
Morning.
But the third one is also with us, but not here in the studios. He is joining us from NSE. Nigel, good morning.
Is he starting the Friday party early? Already out of office.
On work, Surbi, don't get me into trouble. Markets are looking up, so I think this week has been a fairly good week.
Yeah.
No, absolutely. And it's been a long week. It's been an arduous week. We started with the weekend, of course, all those developments. Thankfully, the news flow has improved when it comes to the situation at the border. We're back to talking more here and now markets, more here and now earnings and stock-specific action. And there's been plenty of that as well, Prashant.
Yeah, I mean, statements galore, right? It's like, I don't know what's hitting you from where, but something always is. So let's take it from the top in that sense, right? In terms of what you need to know as we begin a new session. You basically had a mixed kind of day last night as far as Wall Street is concerned. The S&P about 0.4% higher, the Nasdaq about 0.18% lower. So it's not a decisive kind of a day. The 10-year, though, was a very decisive move. The 10-year yield was down 10 basis points. I mean, actually, you can look at the 2, the 5, the 30, all of them down. I mean, between 10 to 15 basis points, 4.43 on the 10-year yield. Now, this was largely on the back of slightly dovish skew for April data. And you had a bunch of, I'm not going to go into the details here, but you basically had retail sales, core CPI, initial claims, industrial production. Not that all of it was bad, but, there was a dovish skew clearly. If you had to pick one data point, which clearly was a miss, it was the retail sales number. So are we starting to see the first signs of cracks in the U.S. consumer strength? But of course, it's also accompanied by softening of prices, which then has implications for Fed's reaction function. By the way, the Fed implied rates basically are expecting 50 basis points, 225 basis point cuts for 2025. The dollar index was down as well, about 0.25%, 100.78. The dollar has moved up. The broader dollar has moved up lately. Oil prices were down, and again, I mean, this week, excluding yesterday, oil's up pretty big. I mean, from about just under 60, it had gone up to about 66. We're back at about 64.5. I was talking about the headlines, right? Trump yesterday claiming that they're very close to a nuclear deal with Iran. And you basically had the top advisor to the supreme leader of Iran in an interview to ABC saying that Iran would be willing to abandon their nuclear ambitions in exchange for sanctions relief. So it's not just from Trump, but of course from the Iranian side as well. Who would have thought? But that's essentially the world we are in right now. The big talking point yesterday, and this happened mid-afternoon yesterday, was, of course, Trump expressing his displeasure with Apple essentially saying publicly that they want to make everything that they sell in the US in India. And essentially Trump saying, well, we've tolerated you sort of making out of China for so long, but well, now come back to the US and India can take care of itself. Lots of back and forth, lots of talk around this, and we'll continue to discuss this. The bigger sort of point to my mind is simply this: can Trump or anyone else, really bridge the cost economics? I mean, there are some estimates which suggest that to make that $1,000 iPhone in the US, I mean, the price basically goes up to $3,500. I mean, it's just not viable. So can Trump or any other administration really force large global corporations to make changes like this? Which are basically based on economics. Longer term, maybe they can affect some shifts, but I don't think, I mean, this really does something in the very near term. But still, I mean, I think these are headlines worth taking note of. Now, just to circle and tie in the levels, Nifty yesterday broke above the high of 24,973. And by the way, it took off like a rocket. And the rocket happened, the takeoff happened mid-afternoon, and it never looked back. So we were by far the biggest outperformer in Asia, in the Asia Pac yesterday. Other markets were largely sulking sideways, slightly higher. Now, the resistance now is 25,000, on the way up is 25,310. It's a level I've put out earlier as well. It's nothing but the 78.6% retracement of the full fall that we've seen. Support stands at the 40-day exponential moving average, which stands at 24,629. You know, typically a week before, the week after next day's expiry, monthly expiry, typically a week before the monthly expiry, markets stall a little bit. So we'll see. I mean, if the market if the market's played out something here in terms of the rally from the lows, I mean, I think we'll find out next week. So in that sense, limited point, perhaps a little. If you're trading short term, a little careful. But those are levels essentially on the Nifty. For the Nifty Bank, we bounced back from the 20-day moving average. Here, the resistance stands at the high of 55,500. It's very close by, about 150 points away. And of course, the support stands at yesterday's low, which is 54,442. GIFT Nifty will give you a quick sense of how we are likely to start. Lots of specific stocks which we will address as well. It's about 100 points higher this morning as well. Surabhi.
Absolutely, Prashant. You're right. I mean, when you said you don't know what hits you from where in terms of news and information flow, it's like those missiles are still coming from all directions, right? And obviously, we're looking at that. So let's start with Asian markets. Asian markets actually have a pretty tepid picture this morning on Friday. A lot of them are falling. Taiwan's the only one that's flashing some green. The Hang Seng is down a lot, 1% down. Mainland Chinese markets also lower. Japan is also lower. So color across Asia is red. Some of the developments sentimentally are kind of souring the mood out there. One is this GDP number out of Japan. There's a contraction, which was expected, but it's more than what was expected. The economy has contracted 0.2% quarter on quarter. It's contracted 0.7% year on year as well. And this is as those trade discussions with the US are still very much underway. So that's number one. There's some negativity around Chinese tech this morning because Alibaba missed estimates. That stock's been trading lower by about 5%. So therefore, I mean, overall, Chinese tech, the sentiment is a little lower. But I want to focus more on a lot of the geopolitical and trade-related developments between India and the US because a lot has been said and the Indian side has also responded. Yesterday, remember, while he was speaking in the Middle East, I think this was a statement in Doha, President Trump said that he claimed that India is willing to reduce its tariffs with the US to zero. He said now they were very high earlier and now they're offering zero tariff. We've got a statement from Mr. Jaishankar on this, and we'll play this out in just a second. Essentially, he's saying the trade talks are still going on. These are complicated negotiations and nothing is decided. Any trade deal has to be mutually beneficial and has to work for both countries. So let's actually hear out the sound bites, what Trump said and what the Indian External Affairs Minister has said on the exact situation or the exact sort of positioning with respect to the US-India trade deal.
You couldn't do business in India. We're not even a top 30 in India because the tariff is so high, to a point where they have actually told us, I assume you too, Scott, you were working on that also, that there will be no tariff, right? Would you say that's a difference? They're the highest, and now they're saying no tariff.
These are very complicated negotiations. They are very intricate. Nothing is decided till everything is. But any trade deal has to be mutually beneficial. Any trade deal has to work for both the countries. And I think that would be our expectation from the trade deal. And until that is done, I think any judgment on it would be premature.
There you see it's out in the open, the quote-unquote disconnect, if I could call it that, between what the US side is claiming and what India's official stance is, at least as of now. And remember, the Commerce Minister is going to be in the US, and let's see what comes out of those meetings. That will happen over the course of the weekend and next week. Speaking of trade, actually, we have our own trade numbers as well, April, and the trade deficit has actually increased for India. The trade deficit now stands at about $26.4 billion, which is obviously substantially higher than where we were earlier. 19 was the number, 19.2 almost in April last year. Exports have gone up 9%, but imports have gone up 19%. And that explains the increase in the deficit. Now let's come back to markets. And here the good news is that the FPIs were back. And even this morning, so whenever we look at the Chinese market actually faltering a little bit, perhaps sentimentally it gives a little bit of a boost. Because if there's a sustained China rally, then it could spell a bit of a difficulty for India. But that's not what we're seeing right now. And look at that solid buy figure. That explains the exuberance on the large cap side of the market yesterday. 5,000 400 crores of net buying coming in. Domestic institutions were on the sell side yesterday, selling stock worth almost 1,700 crores. So FPIs are here. That's good news. In terms of individual stock action, there's a raft of earnings to go over. But beyond earnings, I'll watch out for two stocks. IndusInd Bank, remember, it has not participated in the market rally so far. Last couple of days, it's always been sulking. And now we know the reason why. It seems there are more accounting issues that are coming out of this internal audit committee, discussions that have been going on. We'll tell you more about it as we go forward. And watch out for Bharti Airtel. Our sources are indicating that perhaps Singtel could be looking to sell a little bit of its stake via a block deal today. So two specific stocks in focus as well. Nigel.
Well, the Nifty is back at 25,000, right? But various portfolios are not really reflecting that. That's because yesterday, the Nifty managed to conquer the 25,000 mark on a closing basis. That's the highest we have seen since October 15th. But just take a look at the Nifty Next 50 or the small cap index. They are a distant away from those levels that we saw on October 15th itself. The Nifty has recovered its losses, but the broader markets are yet to participate. So if this market is going to be heading higher, I expect the broader markets actually to participate with greater gusto and maybe in fact outperform from here on. Couple of highlights of yesterday's trading session. Why did we see such a big spurt, particularly midway through the trading session? Because yesterday was weekly expiry and the call writers, they got stumped on the wrong side. And that's why you had a big spurt out there. And just take a look at the NSE option premium turnover. That crossed 1 lakh crore yesterday. That's the highest that we have ever seen. So it was a very, very big day in terms of the options market in yesterday's trade. And that was the reason that we went up, besides the FIs turning buyers. But what do the FIs do in the futures market? Well, in the index futures, I normally tell you all that I like to see FI net short in the market. And that's the way it played out yesterday. Because in trade yesterday, the FI net short positions came down by around 20,000 contracts. They added some longs, they covered some shorts. So that's why the swing factor was close to around 20,000 contracts yesterday. They are still mildly net short. What about on stock futures? Out there as well, there was a short covering bounce that did play out. Because the shorts reduced by close to around 40,000 contracts, while you had long addition of around 59,000 contracts, which is telling you out there you had a swing factor of around 1 lakh contracts. Moving to the options data, well, a couple of strikes are fairly active. The 25,100 call, there seems to be some writing that we've seen at those levels. So those call writers will like to defend higher levels. While the 25,500 call, there was some out-of-the-money call buying. In case this market is ready to go higher, then, someone's taking a punt and paying close to around 44 rupees. On the downside, 25,000 put, that was active in trade yesterday. The premium's around 180 rupees. So plugging in what we're seeing on the options data, well, on the upside, the resistance comes in at around this 25,270. The gift would be suggesting a higher opening, but this is the level that you need to cross to get a bit of a short covering bounce. As of now, the bears believe they can defend this 25,300 odd mark. On the downside, since we saw writing at the 25,000 put, the 24,800 mark becomes extremely important. But the Nifty Bank, that's the one that holds the key. It's been unable to decisively cross that 56,000 odd mark. And we've seen it numerous times in the last 1 month or so. It's gone till there, but it couldn't conquer that. The fresh leg of this up move starts when the Nifty Bank manages to decisively take out the 56,000 odd mark. So broader market outperformance is what I'm looking forward to from here on, and the Nifty Bank taking out that 56,000 odd mark. One stock that I'm looking at is Linde. It corrected close to around 40% from the peak. In the last 1 year, the stock is still lower. But in the last few trading sessions, it's taken out the 20 DMA, it's conquered the 50 DMA as well. And there has been a good delivery-based buying that we're seeing on Linde India. So I'll keep an eye out on that one. Just take a look at the delivery yesterday in comparison to the last 10 days. That's a stock I'll track from here on.
Okay, all right. Got it, Nigel. Let's actually kickstart with the equity call of the morning. Mahesh Nadurkar of Jefferies says since March lows, MSCI India is up 14%. MSCI India price to earnings is now at 23 times, implying that valuations have become demanding once again, especially in the context of FY 25 to 27 EPS CAGR expectation of 11 to 12%, with the usual downside risk. Outlook for flows, both domestic and foreign, remains the key positive, which would be conducive for potential equity supply, which in turn can cap the upside. They have added Ambuja and BEL to the model portfolio and trimmed weights in NBFCs as well as in Coal India. So Mahesh sounding a slightly cautious note because valuations are running up, he says, and earnings may not catch up.
Okay, well, that's the view coming in from Jefferies this morning. Let's get a big fund view. Prashant Paroda is with us, portfolio manager, emerging markets, Allspring Global Investments. Prashant, good to have you with us here. Good morning. Thanks for your time. So a lot has gone on, but let's take it from where we are now. I mean, the state of play as things stand right now. What is risk reward looking to you? For equities and specifically with regards to India, Prashant.
So I think the Indian market has recovered quite a bit since April, and we're seeing activity and some of the sectors such as financials, some telecom and materials continue to do well. And it's a game of expectations where if companies meet or beat expectations, your valuations continue to be rewarded. You get rewarded for that. But if in case you have high expectations and you miss such as in some of the new age sectors, you get penalized for that. So I think India is, this year at least, we see sort of an expectations-driven market. But it's good to see flows coming back from FIIs. And I think overall we are pretty positive with inflation coming down. Hopefully consumption will pick up towards the second half of the year.
Prashant, any sectors or spaces you're excited about? Because, I mean, generally across the board, I mean, it's people are struggling for ideas. Yeah, I mean, there are long-term stories you can bet on and stay invested. But with the snapback we've seen from the lows, at least on a general basis, there always will be a stock here and there. What do you like, Prashant?
Yeah, so incrementally, I think private sector banks, we continue to be bullish because they haven't worked from a 3 to 4 year perspective. So some of them, credit growth is pretty good. Credit costs are also pretty much in line, in check. And as sort of there's monetary easing, some of the credit growth might pick up. Then on top of that, beyond that, we also have exposure to the telecom sector, which is, you can call it a 2.5 player, where, the two players are essentially winning market share versus the other. So India is a pretty unique market. There's some spaces where they're just two players. In cement also, you can argue that the larger players will continue to do well because their cost structure is a lot better than the smaller players, and they'll continue to capture market share. So from a large cap perspective, we're looking at players which continue to kind of gain and get ahead of the market share perspective.
Okay, all right. Hi, Prashant. I recall in February as well, you had made that point, right, with regard to cement looking up in India, and you all were positive, and it seems that's playing out because the worst of the earnings appears behind. But Prashant, if you could comment on this, since US as well as China, they managed to sneak in that temporary trade deal. The fear here in India is, they jumped the line. Everyone is expecting India actually to get a deal with the United States going. Do you think in that sort of a backdrop, could China again return to being the preferred market? Because we saw China outperform. Then India in the last couple of months were beginning to outperform and flows were coming back to India. Your comment on how the situation is panning out within the emerging markets.
Sure. So I guess the difference between China and India is they have very different valuation multiples, right? So the China trade, I think things are moving from pretty bad the last few years to less worse. And things are marginally improving across the board. You see it in earnings as well. With regards to the trade deal, I think, India is still pretty much out there. We have the Commerce Minister. I think he's going to be here tomorrow in US to discuss. And I think we are close to wrapping it up from India's perspective. So I don't think India needs to worry about the backdrop with China. I think with China, their national security concerns, their big picture concerns as well that US has. And with India being in the neighborhood it is, I think it makes sense for the two democracies to kind of pencil in this trade deal finally.
Prashant, hi. India often enjoys the Tina factor. There is no alternative. I don't know if you could hear, I was reading out the latest Jefferies call just before we started this interview with you, and they're exactly referring to that because earnings have been a little sluggish. But if there is no alternative, then India tends to benefit thanks to flows. What is your sense on the market here right now? I mean, are you worried about Indian earnings? Would you be willing to pay 22, 23 times because there is no alternative?
I think, there are pockets like, China, I think is doing okay on a relative basis as well. And I think for the emerging market asset class, if you look at if both India and China do well, actually it's great for the asset class. So one thing we talk about is if both engines are firing, it leads to more flows, more allocations. And one thing this year has taught us is that, everyone had given up on emerging markets as an asset class, but it has come back and it's actually outperforming the US markets itself. So people are paying heed to that. I think Warren Buffett also mentioned in his final letter that there could be scenarios where you would want to own different currencies outside of the US dollar. So I think a lot of that is playing into the mind of global asset allocators. And everybody has been plowing into the same stocks in US for so long. I think it's time to kind of diversify. So I think both if India and China do well, it's actually positive for the asset class and it's positive for India as well.
Okay, all right. Prashant, thank you very much. Good conversation as always, and we'll leave you to it. Have a good day. Or rather, I should say have a good night's sleep, and we'll talk again. Thank you. Well, I'll just quickly run you through the interactions which are lined up here on the program. At 8:35, we'll have the management of Signature Global joining us to talk about their fourth quarter numbers. 9 o'clock, the management of Allied Blenders and Distillers on their fourth quarter earnings. Rana Gupta will talk markets at 9:20, 9:30. Endurance Tech, fourth quarter numbers and outlook. Sharad Mahendra of JSW Energy on their earnings performance. And 9:50, we'll have Daniel Morris of BNP Paribas Asset Management for some more market talk, global this time. 10 o'clock, we'll have the Arvind Management to talk about their earnings. And of course, towards the end, it's Indianomics. Lata will be in conversation with Mithul Kotecha of Barclays and Louis Kujis of S&P Global Ratings on the impact of US-China deal.
Okay, and there's plenty of stock-specific action to track as always. We'll get to it in our top 10 segment. We're looking at names like PB Fintech, Patanjali Foods, Endurance Tech, SKF India, Crompton Consumer, and Keynes Tech on the back of a positive news flow. And Bharti Airtel, JSW Infra, JSW Energy, and IndusInd Bank could open in the red because of some negative news flow. Welcome back. Well, as we've been telling you, the cues across Asia actually are fairly muted. Lots of the bigger markets like China, Japan, Hong Kong, they are all down. Let's get the implied open up. We had, of course, a roller coaster move yesterday and a big dramatic rally by the end of it. We were outperforming a lot of the markets, and the implied open is saying that we could again start about 100 points higher. So let's see. Looking not too bad this Friday. Lots of stocks in focus. Plenty of earnings and news flow to go over. So let's straight away get to it with our list of top 10 stocks to watch. Vivek, let me open out with you. You have your plate full. Earnings, block trades, what all are you tracking?
Well, absolutely. Good morning. Quite a lot of action as far as T Street is concerned. Large blocks have resumed. And today, Bharti Airtel, you will see a significant block that will go through. So sources indicate that Singtel, under the ownership name of Pastel is looking to sell close to 0.8% stake in the company. The offer size is close to $1 billion. So the offer size at yesterday's currency rate is at 8,568 crore. Now, after this, if you're looking at the floor price at 1,800 rupees a share, 3.6% discount to last close, that is yesterday's close, lockup of 60 days on further sale of shares. Now, when you're talking about the current stake of Singtel, under Pastel, it's around a little over 9.2% stake. Post this, when you're looking at the effective stake, it will come to around 28%. That is important. Mittal Group stake currently at 23%. Now, the other stock in focus is JSW Infra. Remember, the company on May 12th had intimated the exchanges that the promoters will need to go ahead and divest close to 2% stake to meet the minimum public shareholding norms. So, in line with that, today there is expected to be a block of 2%. The total offer size of a little over 1,200 crores. And when you're talking about the offer price, it is at close to 288 rupees a share, 3% discount. Who are the sellers? The Sajjan Jindal Family Trust. Through the trustees, both Sanjay Jindal as well as Sangeeta Jindal will be pairing stake. Going with the red on both of these names, but you could see a recovery depending on whether the demand is strong.
Okay, all right, Vivek. Thanks a lot for that. Well, let's hop across to Ritu. She's here to tell us about Innocent Bank. Well, Ritu, stock could be under pressure yet again today.
Absolutely, Nigel. It is fresh trouble for IndusInd Bank after that near 2,000 crore hit from the derivatives portfolio. Two more accounting lapses have now emerged. So in an internal audit, 674 crores was found to be incorrectly booked as interest income in the bank's microfinance portfolio and subsequently reversed in January. That, of course, follows the EY-assisted probe into these issues that the bank had flagged earlier. And separately, a whistleblower complaint has led to another audit, and that is an uncovered 595 crores in unsubstantiated other assets that the bank has quietly offset against liabilities in January. Now, the bank does say it is reviewing the employees who were responsible, strengthening internal controls, and will take action where needed. We've already seen the CEO and deputy CEO step down last month on the back of the derivatives discrepancies, but this makes it 3 lapses in 3 months. So you have brokerages like Morgan Stanley and CLSA sharply cut down the earnings estimates on the back of this. And of course, we're going with the red for IndusInd Bank.
All right, Ritu, thank you very much. We'll come back to this story in greater detail and talk about this, get you more opinion as well. JSW Energy is the next one on our top 10 list. Vivek is here with details. Vivek, morning.
Well, good morning. JSW Energy going into Q4, there were concerns given the fact that as far as demand of power is concerned, this particular summer season, it's been unseasonally or unexpectedly muted. And going into that, there has been weakness as far as merchant tariffs are concerned. So in line with that, operationally, it's been a muted quarter on the back of the fact that merchant tariff rates that JSW has significant open capacity have actually seen quite a bit of a downtick. However, the street may look beyond that given the fact that the company has given very aggressive capacity addition targets and has given a strategy 3.0 as far as the year 2030 is concerned. So let's look at the numbers themselves. Revenues are up 15.7% on a year-on-year basis at close to 3,190 crore. This is below what the street was anticipating. EBITDA at 1,209 crore, again below consensus estimates. EBITDA margin on a year-on-year basis has contracted, coming in at close to 38%. Profitability higher by 16.3%. But remember, there has been a higher other income of close to 100 crore. This is on account of the fact that the company has taken one particular provision as far as Mitra is concerned. So overall, slightly muted set of numbers. But let's look at strategy 3.0 that the company unveiled yesterday. The company now targets 30 gigawatt of generation capacity by 2030. Earlier, the target was just 20 gigawatt. Along with that, the FY 2030 run rate of EBITDA is expected to be almost 2.7 times to 3 times FY 25 pro forma EBITDA. On the back of that, JSW Energy going with the red, but there could be some intraday recovery, especially from long-term investors who buy into the strategy 3.0 of the company.
Okay, all right. We'll watch out for that. Vivek, thanks very much. In fact, the management of the company is going to be joining us at around 9:40 a.m. We'll talk about that strategy 3.0 and the road ahead for JSW Energy. More numbers over to Vamakshi then for PB Fintech. Good morning, Vamakshi.
Good morning, Surbi. Premium for PB Fintech stood at 7,030 crores. This is an uptick of almost 37%, and largely this growth is being driven by the new initiatives that the company has undertaken. The revenue saw an uptick of almost 38%, coming in at 1,508 crores. This is higher than Morgan Stanley's. This is in fact lower than what Morgan Stanley was expecting, but the operational performance has been strong. The adjusted EBITDA stood at 149 crores. This has doubled as compared to the same quarter last year. Adjusted EBITDA margin as well has come in almost 400 basis points higher at 10%. So this has come in much higher as compared to what Morgan Stanley was expecting. They also have come out with the report. They have an underweight call on the on the stock. Target price at 1,130 per share. They say that core new premium growth has moderated to 21%, driven by slower savings growth, but steep valuations drives underweight. Nevertheless, when we look at the numbers, it's a beat, so therefore going with the green for this counter.
Okay, all right. Thanks a lot for that. Well, hopping across to Mangalam. Mangalam, tell us about Patanjali.
Well, incredible numbers coming in from Patanjali, but the street was prepared for that because one, the company had given us their fourth quarter update, and secondly, we already know that palm oil prices and edible oil prices had seen a big surge that was visible in the margin contraction of all the users of these products itself. So revenue growth of 18%, we have an EBITDA jump of 37%, margins improving by a few basis points, almost 80 basis points, and the net profit on the back of that jumping by 76%. What was it led by? Edible oil. No surprises there. 21% growth in the revenue, but the edible oil EBITDA was up by 135%, and as a result of which we saw sharp margin expansion as well. The important thing, however, to watch out for will be edible oil margins have contracted quarter on quarter, and from the peak, edible oil prices have also come down as well. So can we see a contraction cycle beginning from the second quarter is something we'll have to track. For now, the stock opens in the green, but maybe see some sell-off from the top, largely because maybe the best of the cycle is behind.
All right, Mangalam, thank you very much for that. So keep an eye out on those names. Sudarshan is here with Endurance Tech and SKF India in focus. Good morning.
Morning, Prashant. So both the companies have reported Q4 earnings that are much better if you compare both sequentially and year-on-year. First, talking about Endurance Tech, it has reported a steady set of earnings with all the three segments, India, Europe and Maxwell, are doing better and have been outperforming the industry. For profit, it was up 17%, revenue has increased 10%, EBITDA too has moved higher by 8%, and company has managed to hold on to margins above 14% levels. For SKF India, Q4 historically has been better, and it's a healthy set of earnings with sharp improvement that company has seen in margin both sequentially and year-on-year. Profit is up 16%, revenue has increased by 1%, but cost controls have helped margin improvement, and here margin has improved to 23.4% from 18% that company reported in the same quarter last year. So I'm going with green for both.
Okay, so two green stocks on Sud's list this morning. Thanks for that. Upasna, coming to you now. Crompton Consumer and Keynes Tech. How are the numbers looking?
First up, let me start with Crompton. Overall good set of numbers, revenue in line while PAT and EBITDA margin beats the poll. Now, EBITDA margin beat was largely led by the positive margin surprise in company's lighting segment and the healthy growth trajectory in Butterfly. Now, revenue saw an uptick of 5%, EBITDA saw an uptick of 30%, EBITDA margin saw an uptick of 240 basis points at 12.8% versus the poll of 11.5. This was mainly supported by 700 basis points expansion in EBIT margin of lighting segment at 15.9. PAT saw an uptick of 29%, and company's key segment, that is the ECD, it saw a steady growth of 6%, which was in line with the street estimates. Now coming to Keynes, overall good set of numbers. Revenue PAT in line with poll, but it was a EBITDA margin beat, highest in Q4 reported this year. Now revenue saw a growth of 54%, EBITDA saw a growth of 76%, EBITDA margin saw an uptick of 220 basis points at 17.1 versus the poll of 15.8%. PAT saw an uptick of 43%. Now coming to the order book of the company, it remains quite healthy with a growth of 60% year-on-year basis and 9% sequentially, giving a strong visibility for FY26. Now, company achieves its FY25 EBITDA margin guidance of 15%, and coming to the revenue guidance at 2,800 crore, it stands slightly lower at 2,721 crore. So a slight miss on the revenue, but EBITDA guidance intact at for FY25 at 15%. So overall, good set of numbers for both of these counters.
All right, got that. Upasana, thank you very much for the details over there. Let's quickly recap our list of stocks to watch then. The ones that have positive news flow around them are PB Fintech, Patanjali Foods, Endurance Tech, SKF India, Crompton Consumer and Keynes. The ones that have negative news flow around them, Bharti Airtel and JSW Infra on the back of those expected block trades. Then there's JSW Energy as well as, of course, IndusInd Bank. Okay, that's the stock list for the morning. Let's now talk about commodities. We have Manisha Gupta joining in with a roundup of all the overnight action. Manisha, morning. TGIF. What's happening in the commodity markets?
Well, it doesn't really look like TGIF the way the commodities are very, very volatile right now. But I'll start with the gold prices because they seem to be cutting losses. There's a rebound above 3,200. Remember, we've done 31.25 yesterday. It's trading around 3,200, not able to hold those kind of gains. But the support did come in after setback in peace negotiations between Russia and Ukraine. Having said that, the U.S. retail sales are weaker than expected. The U.S. CPI fell as well, and the markets do not have too much of news to continue to gain here. So you might be looking at further declines coming in for gold. Same is the case with the base metal prices also. Well, a couple of positives. One is the optimism over U.S.-China trade relations and the fact that Iran may reach nuclear deal with U.S. Crude is headed for a weekly gain of 1% right now, but the markets are looking at higher supplies from U.S., from OPEC, and from non-OPEC as well, and that would continue to put pressure. Another area which has seen a bit of a decline in the Asian markets right now is the base metal prices. Fell 1% overnight. There are easing supply issues in Congo, Indonesia, Myanmar. The markets also are looking at rising inventories on LME and US, and that continues to weigh onto that space too.
Okay, all right. Manisha, thank you very much for that. So that's commodities in focus there. What we're going to do is we're going to take a quick commercial break here. We're going to come back with the management of Signature Global, who's going to talk to us about their fourth quarter earnings and outlook. Stay tuned.
Welcome back. We've got lots and lots of earnings to look at and numbers to react to. Signature Global is the next company on our radar. And in fact, we have the company's management joining in. Let's quickly recap the numbers as well. For Signature Global, the revenue is actually down 25%. Profit, however, was up 49%. Margins, that's the adjusted EBITDA margin. That's come in at 25% versus 13%. So that's been looking good. And they've achieved 103% of the pre-sales guidance. So let's discuss some of these trends and, of course, the outlook. Rajat Kathuria, CEO of the company, is with us now. Mr. Kathuria, thank you very much for joining in. So give us a sense, I mean, on just how you rate the performance in the fourth quarter. What is the launch pipeline looking like? And what is the kind of pre-sales expectation that you have in this year?
Sure. Good morning. Thanks a lot for inviting us. So, see, if we were to break down the sales for the previous year, because that will give us a lot of, look into the year coming forward. So we sold about 4,100 plus, units at an average ticket size of about 2.5 crore per unit. This was driven both by volume and value growth. In terms of volume, we saw a massive volume jump of about 33%. In terms of million square foot, the area which we sold. Whereas there was a fairly moderate value jump of about 6%. And we've been maintaining that we see value to grow only at inflation-linked sort of, rate going forward. So if we really look at this, we are in line with our guidance that we want to be large, relevant, and trusted mid-income housing player for the region. And in line with that, in years to come, we are fairly comfortable to grow the company at 20% plus growth rate vis-a-vis what we achieved this year and play the same strategy. Mid-income housing for people who are buying their first homes is, what we want to by and large do in years to come.
Rajat, hi, morning.
Morning.
Prashant here. My question remains largely the same. Is what's the level of demand softness or demand strength? I mean, just trying to get a sense with regards to real estate in NCR, Rajat.
So, Prashant, good morning. Prashant, we are not seeing any softness in demand in the NCR region. At least we are not witnessing it. Whichever quarters, we've launched new projects, we've seen a fairly good absorption. Almost 70 to 75% of that stock get absorbed in not much time post the launch. We were planning 1 or 2 launches in the previous quarter, which kind of got deferred, to the current year, the initial quarters of the current year. And that's why, the sales number for the previous quarter was comparatively lower. But we are coming up with these launches, something large in this quarter and again in the coming quarter. So we are not seeing any softness, to answer your point.
Rajat, so, I'm wondering why you're talking about 20% growth when you had 33% volume growth, in the last quarter. The company doubled its revenue in FY25. So 20% sounds very ultra-conservative if you talk about 20% revenue growth on a steady state.
So, Nigel, I wanted to give a more longer-term view.
Surabhi here. Nigel's also coming in. Next question's from Nigel.
Okay. Sorry. Yeah, Surabhi, so see, last year we've grown more than 40%, but I was giving guidance that on a longer-term basis, to say that we'll achieve 20%, I don't think is a bad scenario to have. So, over a longer-term basis, on a consistent basis, we are fairly sure of achieving this 20% plus growth.
Okay, hi Rajat. Nigel here. Good morning. Good to see you on the show. What about average realizations? I think last year it was at around 12,500 rupees. Where is that number headed? And also, if you could tell us any plans on entering the Noida, the Delhi region, because a couple of brokerages were highlighting this earlier.
Nigel, good morning. Prices will continue to rise because there is still lack of supply in the market, and our basic premise in the business has been that, if you're creating supply, demand is getting created because supply is nowhere close to the kind of demand which exists. So prices will continue to go up. We are very happy that price rise has moderated. Over the last 18 to 24 months, you'll remember that, especially in Gurgaon, prices were going up a lot. And, we were getting more scared than, feeling happy about it because, that's not a good scenario from the customer perspective. So price rise will happen. You should assume, these late single-digit price rise over the coming year, and it will reflect in our, upcoming quarterly results. As far as your second question is concerned, we are looking at opportunities, but not close to signing up anything as of now. But yes, whether it's Delhi or Noida, we are always on a lookout for a right trade which may come our way.
No, but Rajat, the last time around as well, you were still, looking, evaluating, etc. But this time around, do you think this announcement will come sometime during FY26?
So, Nigel, see, there is a lot happening in Gurgaon right now, in terms of the new product launches which we are planning. We are comfortably doing like 17 to 18,000 crores worth of launches over the next, few quarters. So our pipeline in Gurgaon stays very robust. Even if you look at the previous year, if we've sold about 8 million odd square foot of sales we've achieved, which had a GDV of about 103 billion, 10,300 crores. We've also added almost close to 8 million square foot, but with a GDV potential of 12,500 crores. So we've been very actively, doing business development, adding new land parcels. So even in the previous year, we spent more than 1,000 crores, in doing newer land acquisitions. So we are kind of, replenishing our stock, but it's about, getting the right deal. We are not just for the heck of it, we don't want to kind of, do something in Noida. If something significant, Noida or Delhi for that matter, or any other newer market, something significant, something meaningful, which could help us in the longer run, and helps strengthen our strategy of doing mid-income housing, we'll take it up, but not rushing into anything at this stage.
Okay, all right, Rajat. Wish you a good year ahead. We'll hold you at these numbers, but you're seeming quite confident on demand, and maybe prices as well move up. Interesting scenario playing out there. Thanks a lot for joining in. Well, let's get some fundamental analysis going. Prakash Diwan joins in this Friday morning. Hi, Prakash. Good morning. Good to see you win. What's your view on the real estate space, and what do you like from there?
Good morning, Nigel. So I think, it's going to be very stock specific, very company specific, because real estate is, end of the day, location specific. But what seems like happening is that the luxury market would probably come into a steady state kind of a growth phase, whereas it's probably the mass affluent market which could probably see some sort of improvement in demand. But it's too early to call that out. And if you look at what's happening in Bangalore or even in the south or at large or even in Mumbai, things are not as robust as what you had last year. So if you want to play the real estate market, it's better to do it through the cement and tiles and, fittings kind of a path rather than, directly into real estate. The only company in NCR which I have always found to be very promising given its portfolio and the way it's grown in the last 2-3 years, deleverage itself and whatever, is TARC. That's a small company called TARC, with an offshoot of the earlier Anant Raj family. And you will find real estate being very, as I said, location specific, and at times you end up having to look at very small names. So that's the only challenge you have, and then of course it comes with its own share of liquidity issues and all that. So, but by and large, nothing very stellar in that sense. Even Signature Global with all these numbers, hopefully it's good for them that the P multiple will start kind of looking reasonable because it's so well priced. So that's what the market will wait for. They'll wait for the earnings to catch up where the P re-rating has already taken place last year.
Okay. Hi, Prakash. Good to have you on. So that's on real estate. Yesterday, we had actually a very long conversation on defense. We were recording a different show. And then I remembered some of the names that you always speak of. I remember you telling us about DCX Systems, for instance. This is more about now tactically from here, what do you buy? Because look at where the stocks have gone. All companies, whether it's PSU, whether it's private names, whether it's something like a solar. So has it become a little too hyped? Is this the time to actually stay away and then go back in later? What would you do with these defense stocks?
Good morning, Sarvi. No, you're absolutely right. It's a tad too late to do it. But given the fact that the government is very smartly positioning itself, the administration is positioning itself as a major success story in terms of self-reliance, moving to global supplier kind of a mode for defense equipment. And remember, there's a huge anticipation of defense budgets going up, whether it's Europe, whether it's even the Middle East. So a lot of these countries will start turning out to be buyers, but for our companies, P multiples are still a stretch. It's 70 plus, 80 plus for some of the big names. While, of course, you have reasons to validate that, like an HL with 60% plus margins will deserve those kind of things at some point. But there's no value at this point in time. If you see a correction in the market, which could be due to other reasons and not related to our economy slowdown or whatever, then it's probably an opportunity to do it. The simple logic is that there'll be a huge expansion of the market. There'll be many more players. You'll probably see some very smart IPOs come through in the next 12 months. And once that happens, you'll probably have better choice. But the existing names are a bit overdone. So be cautious about that for sure. You could always look at, buying on dips because this is something where it's a secular 5-year, 10-year story. It's not something which is going to fade away in a few quarters. So it has runway. But don't overpay for it is what I would feel.
Okay, all right. What we'll do is we'll take a quick commercial break here. There is 11 minutes to go for market open and the pre-open, that is. We'll come back, get you some technical trading ideas as well. Prakash stays on with us. Stay tuned. Okay, welcome back. There's about 9 minutes to go for the pre-open session to kick off. And let's get you technical trading ideas. Sudarshan Sukhani and Sudeep Shah are with us with exactly that. Gentlemen, good morning. Good to have both of you here. Sudarshan, yesterday, mid-afternoon, the fuse was lit and the rocket took off. What's the view today? We closed in a very strong way yesterday with strong flow numbers as well from FIIs.
Yes, good morning. I'm very pleased. Yesterday and for the last few days, I have been saying the trend is up. We must be long and we have to accept the consolidation process that takes place inside a trend. So the or let's call it a 1.5 day consolidation ended yesterday afternoon and the markets resumed their uptrend. Now, as you said, it was like a rocket. Sometimes that happens. Sometimes it is slow and steady. We don't know how that uptrend will come. but we know that we should be long. So that was the view yesterday. Today it's different. For short-term traders, large range expansion days are days which give a message. Another consolidation is coming, so you might as well take profit. So today I would not suggest going long at these levels. Markets may go up. I don't mean that. I think traders should now take profits and step aside. Next week, we will again get a consolidation when new entries can be made.
Okay, all right, no, got that. That's a sensible and sort of balanced view, Sudarshan. Thanks for that. Sudeep, what about you? What would you recommend as far as indices go?
Good morning, Prashant. Prashant, I feel yesterday's breakout is giving some kind of a signal. While we are seeing indices now crossing the December 2024 swing highs and closing firmly with strong volumes. And a lot of stocks across all mid cap as well as the small cap indices have moved really well. So it's a broad-based participation. So what we feel is that we are at the cusp of a fresher breakout here in terms of indices and a lot of stocks also. And while yesterday's rally was around 500 points from the lows of the day, approximately 2%, I feel that today early morning post this gap up, we could see some kind of a cool off, some kind of a consolidation. But overall, now one needs to understand that supports and dips closer to the support zone should be bought into, and 24,800 now becomes a very important support, 24,800, 850, which was a prior resistance which indices were not able to cross. So now any dip towards this 24,800, 900 mark should be used to go long, and overall we are looking at targets closer to 25,400 to 25,500 on the Nifty within the next 2 or 3 weeks. So take it as a positional view, and dips should be bought.
Got it. All right. Good morning, gentlemen. Good to see you, Win. Sudarshan, you go first. Tell us what's your stock picks for the day.
Well, it's mainly mid caps. Alchem is a buy with a stop under 5,200. Grasim is another buying opportunity, stop under 27.75. HDFC AMC is a buy with a stop under 4,600. And BEL is a buying opportunity with a stop under 342. You adjust for gap ups, but I would feel that mid caps and small caps will now get their act together. So be in that space.
Well, indeed, because you tell someone that the market's at 25,000, they'll say their portfolio is actually at 23,000. So let's see how that goes. Thanks, Sudarshan, for that. Sudeep, coming across to you. What's on your radar?
Good morning, Nigel. Nigel, couple of stocks on my radar. The first one is MCX. Here we've seen in the last 2-3 days there has been a good rebound from the lower levels from important support zones of 5,600, 5,700. And we feel that from the current levels, while the stock is above all moving averages, as well as it's giving some kind of a consolidation breakout. So we feel that 6,000 should act as a stop loss here, and overall 6,450, 6,500 are the levels that we are looking at here. The second stock is Shriram Finance. So here also yesterday there was a breakout. The last 7-8 trading sessions the stock was consolidating, but yesterday we saw a strong move. Daily, weekly charts both hint at the up move continuing, and we feel that this rally could the rally could go up to 710 to 720 levels, and this could be bought at the current levels as well as on dips, and the stop loss for the same would be 650.
Got it. Sudarshan, any two specific names. One is IndusInd Bank. There is bad news and stock should open sharply lower today. Just look at the slightly longer term chart. Where does it get to? And if you have a word on any of these defense names, go on.
Yeah, IndusInd Bank gets lower. It doesn't go higher. So, there's no sense in trying to catch the bottom. It's a stock that is best avoided. If you own it, you might like to switch it to a much better bank. I wouldn't touch it at all. Most defense names are very attractive. With the disclosure that I have a very small sort of purchase in HAL, I like that company.
HAL. Sudeep, IndusInd to you. My question actually was more that, I mean, if it opens sharply lower, is it still a good sell, or is bulk of the damage done? Sudeep.
What I feel is rather than trying to go short, I guess on every rise post this gap down opening, one should look at exiting the stock or reducing the exposure. I agree with Sudarshan that yes, this could still continue to grind lower. It might not be an immediate short sell, but yes, if you look at it from a positional perspective, from a weekly or a monthly perspective, the stock is headed much lower. And until and unless we see any close above 850, the stock is a sell on all rises.
Okay, all right. Got that. Gentlemen, thank you both for joining us. Sudarshan, thank you. Sudeep, thank you very much. And we'll speak again at 9:10. 3 minutes to the pre-open. We're going to come back with the management of Allied Blenders and Distillers to talk about their fourth quarter numbers coming up. Stay tuned.
Welcome back. You're tuned in to Bazaar Morning Call. In the next few minutes, we'll be getting you the pre-open rates, and we'll also get chatting with the management of Allied Blenders. But for the time being, let me get in Prakash Diwan into the conversation. Prakash, yesterday, Tilak Nagar, the numbers were good. The stock was bursting up. Today, in fact, we have Allied Blenders. The numbers look pretty okay as well. Any pick you have from this alco beverage space? I'm not talking about what you're going to be sipping in later in the evening, but in terms of a stock call.
So, Nigel, I think given the turbulence, or rather, in spite of the turbulence around United Spirits, I think it still holds its way. You know, it's very clear that the FTA, UK FTA, once it starts kind of getting into effect, you will see a lot of things changing under the Diageo label, and that's something which could kind of be very, the company's been preparing for this for quite some time in terms of, whatever they did domestically in terms of premiumization and all of that. So I would believe they will either make money on marketing some of the imported brands, or they could also start using India as a hub to export certain brands or certain parcels of segments of whiskeys, which is something which a lot of the other players are finding difficult to do. So I would stick to that, and of course it's probably one of the most resilient. There are lots of other names that keep kind of flashing good quarters here and there, but I would not really dip into it at this point in any of the stocks. But yeah, I mean, United Spirits is probably what makes the grade very simple.
Okay, by the way, the stock to focus on, Allied is surely one, which is up 9% in the pre-open. Look at Keynes Technologies. This increase in margin, I mean, the margin has gone from 14.9 to 17.1%. And this increase seems to be going down, of course, pretty well with the market. Stocks holding up. PB Fintech was another good set of numbers. Solid numbers from PB Fintech. That stock also in the pre-open is looking fairly good. 10%. That's what we've got going. Prakash, just before we let you go, any other thoughts on a lot of these other earnings that have come in the last 24 hours? PB Fintech, Keynes, like I said. Yeah, since we're talking Keynes, now that it has a direct bearing on the listed stocks, this whole business of don't make iPhones in India, I don't know if that will cast a shadow on the EMS guys. Your thoughts?
No, I think EMS is fortunately much more broader than that. And the government's already kind of undertaken a lot of steps to, again, build some self-reliance. The new Javer project that was announced on Semicon, it's clearly a step in the right direction to kind of de-escalate these tensions or worries or whatever. But, from going back to the results, I think what's remarkable about yesterday's earnings calendar is that most companies have reported very decent improvement in revenue and or profits, which doesn't usually happen at the fag end of the earnings season. But this has been quite a surprise. It started off very subdued, but things are looking up. And one of the companies that I really like, and it's also reported decent earnings, is Datamatics. But there's so many of them. I mean, you have Arvind and you have Keynes, and there's so many which have done well. But I believe if you look at some of the companies that were not posting very great earnings or improvement in earnings, wherever there's a delta there, you probably see some market appreciation and people kind of start looking at it attractively. So that's the whole thing. But yeah, quite enthused by the kind of earnings that we've seen yesterday.
Okay. All right. Prakash, stay on. I thought that would be the last question, but no, we need to discuss IndusInd Bank with you as well in more detail. The stock is down 10%. 10%. Now, you remember when the announcement came about the previous issue, that is when IndusInd had faltered, and then the bank made it official, the audit committee report came out. Their numbers were very similar to what IndusInd Bank had originally disclosed in the derivative discrepancy. What has happened yesterday, it's a fresh issue. And the amount involved is about 675 crores. They're saying it was accounted for incorrectly. There was some mistake here and there. Let's go across to Ritu. Ritu, the stock reaction, I think the market's simple question is that this is not a small amount. How can the bank say that something was recorded incorrectly? But anyway, tell us, and it's so complex, the wordings of the release that they gave yesterday. What exactly has happened this time with IndusInd?
Well, Survi, effectively, two new accounting lapses have come to light, and this is after that 1960 crore rupees hit from the discrepancies in the derivatives book, that the bank had earlier disclosed. Now, IndusInd says its internal audit department, in a review of the microfinance book, has found that 674 crore rupees was incorrectly recorded as interest income in 3 quarters of FY25, but that the amount has since been fully reversed as of the 10th of Jan. Now, this, of course, follows the bank's earlier disclosure that it had roped in EY to assist with an audit into certain concerns in the MFI book. And now we know the scale of the issue, but even that's not it. Separately, a whistleblower complaint prompted the audit committee to direct the audit team to dig into transactions under what it classifies as other assets and other liabilities, and that probe has uncovered 595 crores in unsubstantiated balances under other assets, which were quietly set off against other liabilities in January. Now, the bank says its audit team has also reviewed the roles and actions of employees, and that the board is going to take steps to strengthen internal controls, hold individuals accountable, and initiate action where needed. We've already seen the CEO and deputy CEO step down from their position to take responsibility for the earlier lapses. But, with these latest disclosures, this makes it 3 major accounting lapses in just 3 months. And that raises some questions around the financial controls and oversight and IndusInd Bank, not to mention the fact that all of these disclosures have come with a substantial lag, even this May 8th report only being disclosed on the 16th of May. So Morgan Stanley, of course, has cut the bank's FY26-27 earnings estimate by 15 to 20%. And it says the FY25 net income could take a 900 crore rupee hit. The results have yet to be declared. CLSA, meanwhile, has downgraded the stock to hold, cut its FY25 profit by 22% and lowered the 26-27 projections by about 13 to 17% on the back of this.
Okay, Ritu, just a clarification. So the two separate issues like you highlighted, one is this 675 crores of interest income that was accounted or booked incorrectly, which is being reversed now. So it will show up in the fourth quarter performance. Yeah. The second, this whistleblower issue, does that have a monetary impact as well?
Well, all the bank has said that there is some unsubstantiated balances which have been set off. So it's unclear if that will have a direct impact. But the 674 crores, of course, is the hit in the microfinance book. So expect maybe the bank's profit, which the management had earlier told us would be in the green, to end slightly in the red for the fiscal year, for the fourth quarter.
Okay. All right, Ritu. Thanks very much. Stay with us through the day. Let's see if anything else comes out. If, this is pretty much the only statement that we have. But Ritu has her ear close to the ground. Any fresh developments, of course, she will keep us updated. Thank you for that. Prakash, IndusInd Bank. Let's pull up a longer chart. Today it's down 7%. But the problem is that every time the believers and the buyers have gone in thinking this is the kitchen sinking quarter, this is the worst, it's over, the asset has good value, it's a fully functional bank, more skeletons keep tumbling out. And it's all about, like Ritu was saying, the questions are on, how are you running the bank? What is the governance standard? How do you make a mistake worth, 1,900 crores, a mistake worth 675 crores? Your thoughts on, what investors should do with this now?
So it reminds me of the old adage which says there's never one cockroach in the kitchen. And at this point, it's just a simple falling knife. You really want to kind of try catching it, and the answer is obviously not. What will turn things around is a complete change in the way the bank is run, in terms of maybe it could be the reset of the management. And after this, I would be surprised if RBI intervention comes through in a significant way. So it will take much longer than what people would anticipate. So if you're expecting this to be glossed over by the market, I doubt if that can happen. It's too large, as you rightly said, and look at the pernicious nature of what's happening. It's not something just about the amounts, but you can't be doing these things for a significantly large, financial play. So stay off is, of course, but unfortunately, there are a lot of people who have been caught. if they get an exit, I would believe that it makes sense to book a loss and not kind of, wait for any rebound just on the basis of some turnarounds.
Okay, all right. Prakash, appreciate you joining in. Wishing you a good day ahead and an even better evening. For the time being, we'll let you go. But let's get in Sudarshan back on the show. Sudarshan, what's your 910 call?
Well, it's BEL, buy BEL with a stop under 342.
Okay, all right. Thanks for that. But let's focus on the stock that we were just talking about. Allied Blenders. Big uptick is what we're seeing in pre-open. To help us out with how was the past quarter and what's the way ahead, we're joined by Mr. Alok Gupta. Hi, Mr. Gupta. Good morning and thanks a lot for joining in. Give us an outlook for this year. Last year you said done pretty well, particularly quarter 4. For FY25, your volumes were around 33 million cases. For this year, where do you see that number headed? Also realizations at around 1,000 rupees per case. Where does this number move?
Morning. Last year, we had internally named as the year of transformation and essentially post-listing multiple areas of focus, primarily being premiumization, backward integration, margin expansion, and the governance culture. As we look into FY26, the theme is year of consolidation. Our gross margins have already moved from a low of 37 now to 43. Our capex cycle is now in position. We will see at least 2 of the 3 capex programs that we've announced to come upstream this year. That should have a positive impact on EBITDA. So we should see further margin expansion. As far as volume is concerned, we are reasonably optimistic that we should be able to see a double-digit growth in volume, but a significantly higher increase in the value growth. So that's really the year way forward on FY26. Margin expansion and a double-digit growth both in value and volume terms.
Okay, all right. Give us a few more details. I recall, when you all were listing, you were talking about getting 100% captive ENA sourcing. Has that already happened? And if you're talking about margin expansion, what should that number look like?
So as far as ENA is concerned, we have a large distillery in Rangapur. That is roughly 1/3 of our captive consumption. We had in September announced acquisition of Meenakshi, a unit in Maharashtra, which is a very, very critical market for us. Part of the capacity is already up and running at 100%, and we are on stream to get the balance capacity installed, which is a project phase. So we will be by FY27 end, 66% captive, and we'll also announce the third investment that we need to make that will get us to 100% captive. So the intent of being 100% captive is very much on track. As far as margin expansion is concerned, the 3 projects that we've currently announced, which is ENA plant in the state of Maharashtra, our malt plant in the state of Telangana, and our PET plant in the state of Telangana again, we believe that our margin expansion should be anything between 200 basis point to 300 basis point once this project up and running, which we estimate should be by FY27. All the projects will be EBITDA accretive.
Alok, hi, good morning. Prashant here. That entire thing with regards to that SIT probe and freezing of bank accounts, etc. Could you give us some idea in terms of what's? I think you denied it that there's nothing of that sort. I mean, could you tell us what's going on? Is there anything new at all?
Can reconfirm what we had stated earlier. Our bank accounts were not frozen. This was a news that had no credits, and the situation continues to be the same. All our bank accounts are up and operating normally.
Have you been have authorities asked for any information, not freezing per se, but is there any ongoing kind of not formal investigation, but any kind of investigation at all?
So first of all, there is no freezing account. It was not the case earlier, not the case now. SIT that has been formed has requested for information from more than 100 companies that were suppliers to the state of Andhra Pradesh. We've been one of them, and we have provided all the information on time that has been asked for as per the normal process, which is being equally applicable to all players in the industry.
Okay. Alok, just a question on any receivables or anything outstanding that you may have from either Andhra or from any of the other southern states, or have you received the whole amount?
Andhra is absolutely on track, so there is no overdue in Andhra. As far as Telangana is concerned, Telangana from the month of October has been paying regular dues on time, and for the last 2 months they've also started to pay a partial overdues. So I think the situation today is significantly better, where money is getting paid for monthly supplies, and every month we're also getting a little more release from the overdue situation. So that's really where we are.
Okay, all right. Very quickly, Mr. Gupta, if you could tell us, the Bombay High Court has allowed y'all to use Mansion House in West Bengal. Where is the case at currently?
Case is sub judice at this point of time. The court has allowed Tilaknagar to respond. So I think we are on wait and watch in terms of what the final verdict on this is. And then we will form up an action plan.
Finally, Mr. Gupta, just very quickly, are you importing anything from the UK as of now? And therefore, to what extent do you benefit, if at all, from the FTA?
So we are the largest importer of bulk scotch as an Indian company. Our export into India with duty payable is about 250 crores. Once this new tariff comes into place, we expect about 75 crores of duty release or lower cost of goods from this policy benefit, as a policy benefit.
All right. Alok, we'll leave it there. Thank you very much for joining us. We wish you all the best of luck.
Thank you very much.
Hope to speak with you again. Stocks up from 300 to 400 in 4 trading sessions. So it's seen a 35% kind of a pop, over the last 4 sessions flat. I mean, this week, basically. So it's a significant big rise. Numbers are good, but if you are, of course, looking at remember, we've seen a large ramp up. About 3 points higher on the Nifty. The sensex is down about 130 odd points. So it's kind of mixed. I mean, 30 down and 100 down on Nifty and sensex respectively. What do we have? Small cap index about 0.6% higher. And mid cap index is up. Small cap index is higher. So, it's the large caps, it's a bit of a mixed kind of a day. At least mixed kind of a start, but otherwise in the broader space, it's not bad, at least as far as the starting is concerned. And then we'll pick up on individual names, etc. If you have the heat map, I think that'll give you a quick sense of things. And then we'll get down to stocks as we always do. So that's the heat map. It's again mixed. So about 30 names are higher. The rest of the stocks are lower, starting lower at this point in time. And I think, of course, we'd want to check out what's happening on IndusInd Bank. Surabhi.
Absolutely. IndusInd is not too bad. IndusInd is down just about 2%. And a part of that reason would be the stock already has fallen. I mean, was there something in the market? The stock has been falling consistently this week. This week, the Nifty is up 4%. The Bank Nifty is up 3%. IndusInd is already down 6% this week. And then you add today's decline as well. So perhaps the market kind of had a sense of this. For what it's worth, the stock is down 1.5% at this juncture. Bharti Airtel lower by 2.5%. Of course, it's that block trade that we're speaking of, which is the focus point here. The other weak names include SBI, Infosys, HCL Tech. These are the names. Then Reddy, Sun Pharma, also on the lower side. So IT is lower, Pharma is lower. Bank Nifty is absolutely flat, which brings me to the top side of the tally. Eicher Motors up about 1.5%. Coal India, Ultratech Cement, Adani Enterprises, Grasim. These are some of the names on the upside, but then the list just dwindles from that point onwards. Some of the auto stocks are still continuing their good form from yesterday. Hero, Moto, Maruti, for instance, are up and about. Eicher is not the only one. So auto is doing quite okay. Banks are flat. And IT and Pharma is weak to begin with. Just very quickly talking about the mid-cap market, because there is some outperformance there. The mid-cap index is up about 0.4% at this juncture. Talk about the gainers. Abbott, after numbers, 3.5% higher. Keynes Tech, like we were discussing, good set of numbers, strong margin expansion, so 5% up on Keynes. Endurance, after numbers, is 3.5% higher. IKS, SKF, all of these are result reactions. SKF is doing particularly well, 7% up, remember? So told us that it's been a really good quarter for the company. And that stock is up and about. Some of the defense names like Zentech, they're still running about 5% up on Zentech as well. So that's pretty much how it's opened out for the time being. Datamatics reported numbers negative, 7% lower. PN Guardkill after numbers down 5%. NCC, JSW Infra, these are also stocks on the lower side. So pretty much reacting to individual news flow and earnings. The Nifty is okay, about 45 lower. Prashant, let's see. I mean, yesterday also we had a very quiet start. And then the momentum picked up during the course of the day. So let's wait for that. By the way, those are the large trades. JSW Infra The large trade that Vivek was alerting us on, that seems to have just happened.
Yeah, absolutely. Just a few other names here. Cochin Shipyard is the #1 volume-led gainer right now. It's up about 2.5% at this stage. I mean, this week, it's up 25%. I mean, that's basically from last Friday to Friday morning now. That's a 25% pop. Keynes is up about 5% this morning. Keynes Technologies is up 17% this week. There is Crompton, which is coming up with a 5% pop this morning. So stocks at about 343. Policy Bazaar, I think Surabhi mentioned, 2.5% higher. Stocks at about 1828 on Policy Bazaar. Zentech is, of course, I mean, the big winner this week. Even within defense, which has done so well, it's up 30% from last Friday's close. Zentech, largely in the anti-drone space. Vari Energy is up 3%. It's, again, I'm just sort of looking at this from a big volume-led perspective. SKF, of course, we mentioned. Data Patterns, another defense name. There's a company called Wanbury. Wanbury is up 15%. That's WANBURY. 320. It's coming up with significant volumes. I've not seen this with volumes like this. 500,000 shares. Right at the word go, but there is action. What else? PG Electroplast, of course, has been doing well. IKS reported numbers, margin expansion, and Surabhi mentioned that earlier. So that's, I mean, 2:1 in the broader market space at this point in time. So it's not a bad-looking screen. Newland is the only large cut. Newland is down 8%, which is coming up with a cut. And Cenorus is down about 7% as well. 504 on Cenorus. The other one is Allied Blenders on the other side. Oh boy. Allied Blenders will come up on your screen. It's pretty sharp moves. It was at it went up to 430. 429 was the high, and it's basically flattened out now. The intraday will tell you the story in terms of what has happened here. As I was saying, there's been a big 30%, 35% pop over the last 4 odd sessions or so. More stocks in a bit. Rana Gupta is with our Senior Portfolio Manager, India Equity Specialist at Manulife Investment Management. Rana, good to have you with us here. Thank you very much for your time. I just wanted you to talk about the Indocent situation, not Indocent and what to do with the stock. But as a long-term sort of money manager, how do you kind of sort of look at things like this, which happens occasionally in finance companies more often than elsewhere? Do you think, a credible private sector person at the helm is what it'll take to bring confidence back, and that's essentially the only thing from here?
The lending business where you get tech deposits and then lend money, the importance of the management team is extremely important. And yes, I think a credible person with a considerable private or public sector experience will help restore the credibility. And basically, I'll make 2 points. The lenders who have a higher cost of funds, they, in order to generate a certain target ROA, ROE, invariably go and lend to the higher riskier segments. And the riskier segment in tough times, there's a little bad asset quality. It's important to recognize the pain and clean it off rather than pushing it away through any restructuring or any accounting methods. I think that has now come to the surface. So I think that's a very important point. And secondly, in recognizing and letting investors know about what's going on and raise capital if necessary, those are all prudent steps, which I think will restore credibility of any financial institutions. Because after all, there is a big opportunity in lending to, let's say, rural India, lending to SME. But I think over-aggression on certain banks' front, chasing yield on certain, in cases, will result into this kind of troubles. But this can be fixed.
It can be fixed. Well, investors are hoping it gets fixed, and we don't have to, keep looking at sudden pieces of news of this nature from the bank. But anyway, good to have you on the show. Thank you so much for joining in. I just want to get your sense, Rana, on financials overall. I mean, what are you buying here? Because even with large cap banks, this quarter has told us that growth could be a challenge, though asset quality is okay, credit cost is coming down. But it's all about growth. So do you like banks? Are you looking at insurance companies? Are you looking at capital market institutions? What do you like in BFSI?
So the financials, we like the entire space. Okay. I think given the way even the global setup is, whereby we are seeing, dollar declining, emerging market currencies, and the rest of the world catching a bid. It is good for the liquidity environment. It's good for the central bank like RBI, who has maintained prudent policy so far, also to inject more liquidity and cut rates. So I think the credit growth, it is weak right now. It will probably remain weak for the first quarter or so. But we expect a good pickup in H2 of the current financial year. And I think that growth, because of that, we like most of the lending institutions, including top class private banks, as well as the large non-banks. Non-banks, although I think in the result they said that not much scope for margin expansion, but I do think there will be some margin expansion playing out in the non-banking segment as well. The credit quality, I think, is still quite okay. Of course, microfinance and certain unsecured small tickets are a bit of a problem. But again, it's a pretty localized problem. We do not expect it to be a generalized problem. We also like the financial services segment, particularly insurance and capital markets. And the way the sectors that we like there, if you basically the aggregators, the distributors, I think companies like who are aggregating and selling insurances, the companies like who are offering wealth management services, they are, I think, a very good and clean play on the rising domestic savings and investment into insurance and capital markets. And this is going to be a pretty long-term structural play.
Hi, Mr. Gupta. Good to see you. And in fact, look at the way BSE has rallied. That's one of the financialization listed themes as well. Valuations going out of whack, but the street believes there's a long runway. So let's see how that goes. But Mr. Gupta, let's talk about this China plus one theme. Let's talk about some of these fancied sectors, the EMS plays. Everyone's building in that India can take some part of that share from China. Do you believe so? EMS, chemicals possibly. Or would you play this theme?
In terms of China plus one, I think the long-term theme of multinational corporates diversifying out of China remains intact. And this theme started not now, this theme started some time back and will continue to last for a very long time. Progress will, of course, be gradual because relocating supply chain or developing a new supply chain takes a lot of time. So in that context, I think the sectors that we still like for the longer term in this segment will be the electronics, EMS, electronic manufacturing services sector. I will also additionally add pharma, CDMO. That is one sector that we like. I will also add textiles, particularly in the context of the new FTA signing that has happened. I think textile is also one sector which can look very, very interesting from a medium to long-term perspective.
Got that. CDMO, EMS, textiles, these are all areas that you are bullish on. On the EMS thing, I mean, would you play any heed at all to these comments from President Trump yesterday about, not that the EMS industry is largely dependent on Apple. I mean, Apple, for example, the largest player, Dixon, has no exposure. It's all Android. But would you pay any heed at all to these comments?
Well, I think, the EMS industry, Apple is selling all their US, the iPhone they're selling in the US, they're sourcing it from India. And it took them quite a while, I think 5, 7, 10 years to do so. Although Apple has promised, significant investments within US, but, start producing Apple phone from day one is not easy. There is a huge component and huge supply chain that is required. Setting up that takes a long time. That is why I think it is only fair for these larger companies to have diversified supply chains. I think over a period of time, they will develop something in US also. That could happen. But that does not mean that, India will not get its share. For example, we talk about Apple shifting production out of China, but that's probably 20-25%. Their mass scale, their production in supply chain in China still remains, and they continue to produce and sell to the rest of the world. This supply chain removing and establishing cannot really happen overnight. It takes 5, 7, 10 years. So while that comment is important and maybe a guide to Apple, but it will take a long time for them to set up something in US.
Talk is cheap, as they say, right? but that is what it is. In textiles, you're talking about apparels, or is there a subset here, or you own a bunch of them, Rana.
Yeah, textile is it's an emerging theme in the sense, the stocks are not very large and liquid in that space. But typically, we are looking out apparel exports out of India. And given the advantage that India might have in terms of tariff differentials, India has a good chance to gain market share in that segment. And also, as we are aware that the other main apparel and garment exporters, those countries face certain challenges. So I think both in all put together, it is quite possible that India can gain market share in this industry.
Okay, so that's apparel. That's another area in focus. Markets down about 0.25%, so it's a bit of a cautious morning, 60 points lower at this juncture. But mid-caps continue to fly away. I mean, 0.5% up on the mid-cap index. Cochin Shipyard, by the way, reported numbers yesterday. That stock's continuing to find more traction. Though I think on the margin, it was a bit of a miss. But anyway, the market's mood is very different on defense stocks of late. So this is what we have going. Crompton, like Prashant mentioned, still looking good. Kalpataru projects, 6% higher. Data patterns, Zentek. So, defense is still a very, very strong theme. Rana, speaking of defense, I mean, it's really been the theme of this week, right? I mean, the index is up some 9%, the Nifty Defense Index. And the stocks all of them are just literally touching the sky. I don't know, do you already have some exposure here? Or if you don't, for those who don't have exposure, is it too late to now jump on the bus? What's your advice?
I think within industrial space, there are two sub-themes that we like. One is, of course, we just discussed the electronic manufacturing, and second is defense. Defense is more because of import substitution, and defense we would prefer some broad-based plays. If one is buying a particular company targeting a particular segment, that will go through its own ebbs and flows and huge amount of volatility. For us, it's very important to get the returns, but also manage the risk. So that's why I think it's we would think someone who is diversified has exposure to a number of segments where the investments are happening. Because let's be very pretty clear, I think rising defense expenditure and more localization, it's not just in India, but it's a global theme. So I think we would continue to see that going on. And our take would be that buy the one who is more diversified, or rather look at the one which is more diversified and has exposure to multiple segments. That is to reduce the volatility, but also get the long-term uptrend.
Okay. All right, got that. Ran, thanks very much for joining in and giving us a perspective on the market. You have a good day and a good weekend as well. Thank you very much for joining in. Moving on now to the big story of the hour, actually, a story that came out last evening. More disclosures from IndusInd Bank that raise more questions. The bank has spoken about two specific accounting issues now, in addition to what was, in early April, the derivative discrepancy. We have Abhisar Divanji, founder at Neostrat Advisors, joining in. Abhisar, good morning. Thanks for joining in. So, for the benefit of our viewers, I'm just recapping what are these two new issues at IndusInd Bank. One is that the internal accounts department, let's put up the graphics as well if we can, so viewers are aware of specifically what we're talking about. There is a 674 crore rupee entry which was incorrectly recorded as interest over 3 quarters. The bank has said all of this will be reversed in the 4th quarter. And remember, IndusInd Bank has not declared numbers just yet. So the 674, they're saying they've reversed it in January. So net, no P&L impact. That's number one. The second issue that the bank disclosed yesterday was that there was a whistleblower complaint. And on behalf of that complaint, again, the internal accounts department went into check transactions recorded in other assets and liabilities. Now, they're saying that there were unsubstantiated balances aggregating to 595 crores in other assets account of the bank, and these were offset against corresponding balances appearing in other liabilities. Let's ask Abhisar what all of this means. Abhisar, I think the market's view is clear, and IndusInd Bank is a big underperformer this week.
Yep.
The Bank Nifty are up 3-4%, IndusInd is down 6-7%. So the market's view is very clear that there are way too many mistakes happening, and mistakes that are involving large amounts. Let's take the second part first. What does this mean? Unsubstantiated balances aggregating to 594 crores in other assets, but they've been now offset against other liabilities. And they've not clarified whether this means a P&L hit or not. Can you help us understand this?
Yeah, so, in banks' balance sheets sometimes, They have unreconciled suspense accounts. They have normal suspense accounts where entries bounce in and out. Like the derivatives transaction, for example, was also sitting in other assets and other liabilities. So what happens is that sometimes the way the accounting works is that an entry is made in income, for example, bounced off the other asset and then bounces out back when it gets reversed out, when the interest is collected or whatever. And that's how the other assets, other liabilities pan out in a bank. Now, it's important to note that even suspense accounts, which is accounts where unreconciled or unexplained balances also sit in other assets and other liabilities. So technically, unless one goes to the root cause of what these other assets and other liabilities were, which I'm sure IndusInd has done but not disclosed, at least to the in publicly declared forums, then one would not get an appreciation of exactly what was this. Having set off could have been the right option. But one needs to explain what these entries were, what the root causes of these unreconciled numbers or unsubstantiated numbers were, and how have now they been substantiated by netting off the other assets and other liabilities. Needs to be explained.
Okay, so you're saying that it's not something that is unheard of. It is done, but we don't know the rationale or the reason, and maybe we'll have more ideas. Now let's talk about the one that's causing the P&L hit. This 675 crores. I mean, how do you incorrectly recognize an amount as interest income for 3 quarters, and now that you're reversing the entire amount? What's going on here?
Incorrect is a harsh word, especially for the auditors as well as the internal auditors. Because we normally, don't certify balance sheets as correct or incorrect. So incorrect is a bad word to use, in my opinion. However, what would have happened here is that normally interest income in banks is computed through the system. And many things could have happened, and there's only a guess here because, again, there is no explanation, is that, normally interest income is calculated by the system basis the loan and the input data. It could have been one that the input data was incorrectly entered in and hence the interest income was recognized. Could also have been that an NPA account, especially in MFIs, may not have been tagged as an NPA and the interest income would have continued to have accrued. These things are possible. But unless there is an explanation as to how this income was recorded, it's obviously not an accounting entry that's manually passed, in my opinion. Okay. These are systemic entries. But the root cause, the Surabhi of everything is that why don't it disclose comprehensively what the problem is? You're dealing with a bank which has lost confidence because of the derivatives issue. Thereafter, successively issues are coming out. And the issues are coming out as in they're dripping out of the balance sheets. And when they're getting dripped out, also we get reasons like incorrectly recorded or offsetted unsubstantiated balances. I think there needs to be a far more clear and explanation of the root cause and the remedial measure done, so that people know that these things are not systemic. Otherwise, by default, people would think that there are many more things that can come out of this balance sheet.
Abizar, hi, morning, Prashant here. What happens to existing auditors? You think we will see more heads rolling?
Well, the auditors will have to do a lot of explanation here clearly as to how they established what they call internal controls on financial reporting. There's a norm in auditing called internal controls on financial reporting. It basically means what are the controls to make sure that the numbers are substantially true and fair. So they will obviously have to explain whether there were glitches in there, whether those controls had failed, and if so, why did they not detect it? I think that, but they are the last line of defense. There is internal audit, there is the company's accounting itself. So I think there are many lines of defense that need to explain this.
Abizar, now let me ask you slightly, markets are always hopeful creatures, right? They're already looking at where the stock is and saying, well, it trades at 0.7 times price to book. The book, though, is we're not very sure about what the book is, but with what we have for now. Let's talk about next steps. I mean, I think they've hired an executive search committee to send, they're looking for a leader. Do you think that is essentially what markets will wait and watch? And I'm just looking at the stock reaction now. It's corrected a little bit this week, but markets are clearly focused ahead. What's your sense?
I'm no market expert, but I can tell you how turnarounds would possibly work. And what will happen is that, yes, there will be a new CEO. There will be a period of stabilization where the CEO will take stock of everything because he really doesn't want dripping information to come in later on. So there'll be a taking stock situation. Then there will obviously be a remedial time where growth will take a backseat, but governance and regulation will take a front seat. And then I think a growth strategy will start. So I think we're looking at a 3 to 4 year turnaround period over which obviously growth will be the least important.
And it's possible that whoever comes in, I mean, if so required, you have one of those, I mean, famously, SBI, I think, when there was that big kitchen sink exercise, right? Many years ago. So, no, I'm not suggesting one needs to happen, but it's possible, right? I mean,
I think they will want to clean up, the balance sheet to make sure that the start is cleaner. I mean, we saw Yes Bank happen as a successful turnaround after so many years. So yes, something like that would happen.
3-4 years, Abzar. So then 3-4 years. So what started as a 1,900 crore rupee, and I remember we had a conversation when the original, derivative issue was disclosed. Now, obviously, Mr. Katpalia is on his way out. Do you expect more heads to roll? Do you expect the RBI to step in a clearer way in any measure? Because we thought that it's over and done with that derivative issue, but then they keep coming up with something new or the other.
Yeah, but I think there's a good structure being put in place at IndusInd Bank, to run this whole process. I don't think RBI will interfere too much in it. Should not, in my opinion. But what will work is that let this structure decide on a good stable CEO and give it its time to recover.
Are these? How would you? Abhijit, finally, I mean, how would we don't hear of so many such issues with other banks? Why is this becoming a bit of a repeat phenomena with IndusInd? I mean, no one's alleging that there's some malified intention here, at least none of that till now. Why is this happening? We don't see this with other banks.
So I think, what's happened is generally if you look at mid-sized banks, they've all been through a level of crisis over time. And any crisis manifests more on them, on their balance sheets. Like the MFI crisis would have hit the mid-sized banks more, and they got impacted, in terms of valuations, in terms of perceptions. And when these kind of things happen, sometimes desperate times calls for desperate measures. So people take these measures over a period of time. And then in the quest to grow significantly other parts of the business which are doing well, to make sure that the parts which are not doing well are covered well, sometimes errors do happen. So I think it's part of running business, in my opinion. So I think the way to deal with it is, if there is adequately capitalized banks, we will have not much of an issue.
Okay. All right, Abhijit, we'll leave it there on that note. Thank you very much for joining us and giving us perspective in these two fresh developments, the whistleblower complaint and the 675 crore rupee interest income accounting that needs to be reversed. Let's actually move on. Markets are still down about 0.25%, so not much changing. That's where things have settled. Bank Nifty and Nifty both are down 0.25%. So let's move on to some more earnings and some of these conversations. JSW Energy is the next company on our radar. Now, the company reported an operationally weak set of numbers for the quarter gone by. To talk about this, we have with us Sharad Mahindra, Joint MD and CEO of JSW Energy. Mr. Mahindra, great to have you on. Thank you for joining in. So let's just talk about your own assessment of FY25, the way the year played out for you. You had some acquisitions and you obviously, are also scaling up. So tell us, what is FY26 looking like? Can you start with some targets?
Yes, FY25 has been a phenomenal year for us at JSW Energy. In terms of when we started the year at 7.2 gigawatt and we have ended the year at close to 10.9 gigawatt. It has been through both inorganic and organic routes, the capacities which we have added. And these are highly attractive, return accretive capacities which we have increased. We have been able to commission greenfield wind capacity of 1.3 gigawatt of our ongoing project, which is 1/3 of the country's wind capacity which has been added during the year. So all these things gives us a very strong foot entering in FY26, and we are absolutely certain that FY26 will be a significant year for us, both in terms of further capacity additions and in terms of the returns.
Well, so power demand trends for the summer have been muted. How are merchant tariff rates sort of panning out right now?
If we see last year, the average merchant tariff for the year was 4 rupees 47 paisa. And Q4 showed some increase, but in Q1 till now, in first 45 days, we have seen further increase in the merchant tariff. But here I'll just like to inform that for us, now the open capacity has reduced significantly to almost our operating capacity of 10,875 megawatt when we started the year. Only about 975 megawatt is open. And out of that, only close to about 9% of the capacity is now on imported coal. Rest all is like our Utkal unit in Odisha and the KSK acquired capacity, out of which 100 megawatt is open. All are based on domestic coal. So our fuel cost gives us a significant advantage being close to the coal mines. So even with the tariffs which are prevailing, these appear to be a very, very good opportunity for us to sell in the merchant.
Okay, got that point, sir. You recently converted short-term capacity with the long-term PPAs. Can you tell us what's the percentage of this conversion and what is it that you're still selling out there in the open market?
See, one is that, of course, the acquired portfolio of KSK with operating capacity of 1800 megawatt, 95% of the capacity is tied up with complete 100% of the fuel linkage. So that has increased our tied up capacity in long term. And also our Vijayanagar plant, which has been an imported coal-based landlocked plant where the fuel cost has been higher, has been totally converted into the long-term PPA, medium-term PPA with our group company, JSW Steel, with their increasing capacity. So that reduces our dependence on the imported coal, which by nature is volatile in nature in terms of pricing, in terms of currency movements. So that insulates us from those uncertainties.
Got that. What is the timeline for the O2 acquisition? What's the sort of operationalization timeline and then its contribution to financials?
O2 contribution we have executed on 9th of April. So it is a part of our JSW Energy under JSW Neo. So it is fully is part of JSW Energy effective 9th of April. So, and with an operating capacity of 1.34 gigawatt when we acquired, and during Q1, we are certain that another 500 megawatt of capacity will get added, taking it close to about 1.9 gigawatt by end of Q1. And during Q2, another capacity addition of 300 to 500 megawatt, which will happen. So it will be a 2.2, 2.4 operating portfolio by end of H1.
Okay, got that point. You've also announced a pretty large fundraising program. So what is the likely mode? I mean, are you using the equity route, debt? What will be the mix? And what will you use the money for?
We have said, which I will be talking about, that earlier when we announced Strategy 2.0 of reaching 20 gigawatt of operational capacity and 40 gigawatt hour of storage by 2030, with the first timeline which we announced that end of FY25 to reach 10 gigawatt, as we have achieved the first milestone by reaching 10,875 megawatt of operational capacity, we are announcing today our Strategy 3.0 of 30 by 30, means reaching 30 gigawatt of operational capacity by FY30. So this is one on which we have already have the orders in pipeline, the PPAs executed, under construction projects. So for all these things, the capital which is required, we plan to have a capex of close to 1,30,000 crores from FY26 to FY30. So this all with this significant capacity additions which we are doing will help us going forward from next year more of a generation of free cash. But yes, if required, we have taken the enabling approval for this 10,000 crores as and when required, because our growth has always been prudent, our benchmark ratios to be what we have been talking of, what the rating agencies look for, we will definitely be below that. Whether we raise this equity as and when, we'll decide on which instrument we will go for at the appropriate time, and also whether in one or two tranches, that will depend on the capex requirement, what we are going to have, and the timing.
Got that. So are you open to buying assets in the thermal space, especially in the stressed assets? Lots of assets are stressed and available at decent valuations. Are you looking at them?
Presently, if you see in thermal space, like we have signed a greenfield power purchase agreement to set up a 1.6 gigawatt of ultra supercritical thermal plant when we have signed the PPA with the state of West Bengal. We will be now focusing on that, for which the work at ground has already started. And the KSK asset which we have acquired gives us a very unique advantage with 1.8 gigawatt operational and balance of plant ready for 3,600 megawatt. The fourth unit of 600 megawatt, 40% of the work completed. So we are certain that we will be focusing on this 1.8 gigawatt capacity expansion, which will be at a much, much lesser cost as compared to the benchmark cost of setting up any thermal plant. So we will be focusing more on this and our pipelines, organic pipelines, what we have. So our main focus will be on execution of the entire order portfolio which we have, order pipeline of more than 30 gigawatt.
Okay, got that. Also, can you give us a quick update on the renewable side? I mean, whether it's wind turbine generation or the green hydrogen plants that you have, where have you reached and what can we expect this year?
See, I'll start with green hydrogen. Green hydrogen work is at the final stage of completion, and we expect the commissioning of this plant between June or July of 25. So it's just few months from now when we will be commissioning this plant. It is at final stages of readiness. And regarding wind turbine manufacturing, as we had earlier said, also informed that we have signed technology license agreement with SANY. So I'm happy to tell that SANY manufacturing unit for WTG supplies to us in India has already started, which is in the state of Maharashtra near Pune. And also to further optimize our cost and to ensure de-risking, we ourselves are setting up 2 plants of wind blade manufacturing in India to take care of our requirements. Both these plants will be commissioned in the current financial year only.
All right, so we'll leave it on that note. Thank you very much for joining in and giving us some perspective on your business. That is JSW Energy at the end of the fourth quarter. Need to take a very quick break. We come back to markets. It's a little bit of a cautious morning here in India. We'll have with us Daniel Morris of BNP Paribas Asset Management in our studio to give us some perspective on everything that we've seen over the last few weeks. Welcome back. Still continues to be a steady morning of trade. The bias is slightly negative on the large cap screen today, about 0.25% lower on the Nifty, and the Bank Nifty is also down by the same amount. Mid caps are having a better morning. Well, as promised, let's get that conversation going with Daniel Morris, Chief Market Strategist and co-head of the Investment Insight Center at BNP Paribas Asset Management. Daniel, thank you so much for being here with us. It's great to have you in person. The world has been a very interesting place, to say the least, over the last month and a half. So let's start by understanding, I mean, at your level, when you talk about asset class calls in markets around the world, there was the love everything America move. Then there was let's go away from America move. Then whether you want to go to India or China. So just give us a top-down view of, the investment call and the framework that you're working with right now.
Yeah, well, the contrast between the very much everything in U.S. equities that you felt after the election. And, imagine if someone had come to you then on this show and said, no, forget America. You should buy China or you should buy Europe. You probably would have escorted them quickly out of the studio. But that's turned out to be the right call. I think what's perhaps a bit healthier today is it is much more balanced. So we're modestly overweight equities, so we do think it's a positive outlook. But honestly, no geographic call today. It's not obvious any particular region or country that you'd have a high level of confidence that that's likely to outperform or for whatever period. So we're pretty neutral geographically right now. As always, wait to see what develops to see if there's something that looks more appealing.
You said you're only moderately overweight on equities.
Yeah.
So you're cautious overall. So just run us through that.
Well, there's still, you hate to say it, but plenty of uncertainty. So to have a view where you really would want to be very overweight equities, we wouldn't think would be prudent. I mean, we're really still, and will be, honestly, for probably a couple months yet, assessing what the macroeconomic impact on growth is going to be of the tariffs. Many scenarios we can discuss, but since we don't really know which one's going to play out, having a high conviction call we think right now is not appropriate.
Any anti-consensus views, Daniel? I mean,
to be honest, even be modestly overweight equities could arguably be anti-consensus. There's still plenty of people that think you're going to have, or certainly the risk that you're going to have a much more significant slowdown. At least in the U.S., people do still talk of a recession, even if hopefully the odds of that have fallen. We have to see what the actual impact on inflation is. And the other thing to keep in mind here, without question, the tariffs are going to be negative for growth in the short term. But that's happening in a context where growth in the U.S., at least, was already slowing for other reasons. Remember, we talked about a soft landing as a scenario for the U.S. before the election, which meant that consumer demand was going to slow and growth would fall. That's actually probably happening anyway. And then you add the tariff shock. It's a bit unsettling when you try to forecast what's going to happen with growth.
With China, the view is that maybe we've seen they have some sort of a handshake deal for now, and then we'll get probably like a MOU and then probably a deal later. But even back in 2018, China actually started slowing down when those first set of tariffs, etc., were imposed. I'm asking this in the context of India, because generally, if you read the press, if you read, the view is China has come out on top. With regards to negotiations with, they've not given in very much, and they've been able to reduce tariffs to 30%. Is that? Would you agree with that, Daniel, or you think we will see another leg of slowdown in the? Look at what happened in 2018, and this is much bigger.
Yeah, I probably have a slightly different view of what's occurred. In terms of the reductions we've had, I think the initially very high tariffs, the objective was to get to the negotiations. The idea was not to leave them there permanently. So the fact that they've been reduced, well, is because we're negotiating. So from that point of view, I don't know that I see that's the case. But ultimately, it's going to come down to what the agreement is. And I don't think anyone assumes it's going to be an easy discussion. I think, not only with the negotiations with China, but essentially with all the U.S. trading partners. What the U.S. wants to see is a reduction in tariff levels vis-a-vis the U.S. And ultimately, we have to see how successful that is, and then we can assess whether or not it turned out to be worth all the turmoil that we've gone through or not.
On tariffs, yesterday, President Trump made a very interesting statement. It was picked up widely by everyone in India. I know you know what I'm talking about, right? He's calling up Tim Cook and saying, don't make phones in India for the U.S. How do you think, this is an example I'm picking up, how do you think this is going to play out in terms of corporate America sentiment? And again, I go back to the main question that I think this is why you're not too optimistic on equities. But what are you pricing in, for the rest of the year, say, in the U.S. market or any of the other regional markets that you may like?
Well, I think we need to think about, people discuss what are the risks to growth. And one of the points that people highlight is uncertainty. So supposedly we're also uncertain about exactly what's going to happen, and therefore you're worried about the impact of that on growth. But I think one thing is pretty certain, which is you are going to have tariffs in the U.S. And the point then is it's a clear message to businesses that if you want to avoid those tariffs, you want to produce in the U.S. So regardless of whatever statements you might hear from the administration, any company is going to be evaluating, I can produce or attempt to produce more in the U.S. And therefore avoid the tariffs. And if I produce elsewhere and import, there is going to be a cost. So it's going to be ultimately a financial assessment that every company is going to make as they should.
So as investors, and what is your overall portfolio architecture? You're saying moderately positive on equity. So what else? Do you like treasuries? Are you advocating a bigger shift towards gold? So what's the portfolio call at this point, given the environment?
I guess two key positions to mention outside of equity. So within fixed income, the view is a relative preference for European fixed income versus the U.S. To be honest, it's relative. I would say simple. But in Europe, it's a bit more clear in that you are certainly going to have lower growth because of the tariffs. Tariffs are going to likely to reduce inflation in the Eurozone. You worry about an increase of Chinese exports to Europe to offset the U.S. All of that negative for inflation, or at least bringing inflation down. And then, of course, the ECB is cutting rates and the Fed is not. So it all suggests that on a relative basis, you would have a preference for European fixed income, which we do. And then we still have a modest preference for gold. We had a much bigger one previously, but needless to say, gold has moved a lot. So not quite so optimistic about the future, but nonetheless, the two key drivers of the performance of gold over the last 18 months, number one, central bank reallocation of portfolios from treasuries to gold. That's likely to continue. And if you can call it the Trump premium in gold prices, that's probably going to stay, even if, all the volatility that we expect around it, but not likely to disappear either.
A great conversation, Daniel. Thank you very much for dropping by. It's a pleasure having you here.
Thank you.
Well, what we're going to do is take a quick commercial break here. We're down, 65 points, 24,900. Actually, we're at about 25,000 as things stand right now. Let's actually welcome in the next management who's joining us. I'm talking about Arvind, which reported numbers. And here, of course, as you heard from Rana Gupta of Manulife earlier, a fair bit of excitement. We have Kulin Lalbhai, Vice Chairman at Arvind, now joining us. Kulin, good morning. Great to have you with us here. Appreciate it. Just a quick run through of what you've seen. I think we're speaking for the first time after that India-UK FTA. So I just wanted to start with that before we drill down to numbers for the quarter, etc. What is your assessment, Kulin, in terms of what this can do for Indian textile exports?
I think the UK FTA is a seminal event. I think it's an extremely strong positive for all the high labor-intensive sectors in the country. And the UK is a large trading partner as far as apparel is concerned. And currently, India's share is quite small. We export $3 to $4 billion dollars worth to that economy, and we can easily double it as a country in a shortish period of time. So I think this will be a big positive. I think you will see the scale up play out over the next couple of years because it takes a certain amount of time to build more capacities in garmenting and for brands to start reallocating supplies here, because we had a huge disadvantage with the UK. All our competing countries, Bangladesh, Vietnam, etc., had a 10% advantage, which has now got nullified. So it's a very strong positive for the sector.
Kulin, hi, great to have you on. So it's all about trade, right? Just give us a sense of your exposure to Europe, to the UK specifically, where we've already done that trade deal, and the US. In terms of exports for Arvind, which are the key markets and in which order? And within that, UK specifically, if you could tell us that if you stand to benefit because of this FTA.
So our current exposure to the UK is not very large. It's around 5%, but we see that as a very large opportunity. I think this is our chance to look at that market very differently. And we are already thinking through how we will scale up our exposure to the UK. Our US exposure is much larger. That's around 30% of our overall revenues. And even there, we are seeing that after all of these trade uncertainties, I think generally brands are looking to using India as a strategic future sourcing destination. So over the last month and a half, we are seeing a lot of US brands also talking about being more strategic with Indian vendors and thinking of ramping up capacities.
Okay, so UK could be an opportunity. Got that point. So let's talk about the domestic market outlook as well. And then I want to come to the overall picture for FY26 because there's so many moving parts. Domestic market, when you're looking at volumes that you have visibility on this year, maybe pricing, give us a sense on pricing as well, on both counts for the local market.
So last year, the consumer sentiments in India have not been at the best. But the first quarter of the year, at least as far as our textile business is concerned, we are seeing reasonably good demand from the Indian brands. So currently, we are cautiously optimistic that as the year progresses, the demand scenario should be better than that which we saw in FY25. And possibly as we move towards Diwali, as the inflation reduction kind of plays out, as the tax cuts kind of play out, we do expect an uptick in the consumer demand in the quarters to come.
Okay, so you're expecting some improvement in the local markets. Like you mentioned, you're looking at opportunities in Europe as well. What about the US? Are you worried about that 30% exposure given this, unending almost protectionist talk? And we don't know what's the shape and form of the deal with the US. Those details aren't out yet. But could there be a concern there?
You're very right that there is uncertainty. I think the way to look at this is to look at it from a window of relative attractiveness. And even with whatever trade talks have happened with China, China still stands 20% higher than India on tariffs. That's not a trivial number. And the US highest exposure still remains with China. US imports around $100 billion of apparel. 22% of that comes from China, whilst India is just 4%. So relatively, we still remain better placed. And we are seeing, as I mentioned, the body language of global brands to look at India differently and to scale up capacities here. I think in the short term, this does lead to uncertainty. There will be some tariff-related potential impacts on margins in the very short term. But we are seeing volume compensate for that. So brands are saying we would want to give you much more volume. Just help us out a bit with the very short-term impact on the tariff side.
Yeah, one just hopes that the US president doesn't start calling up the Gaps of the world or the other textile or apparel majors in the US, like he called up Tim Cook yesterday, saying, please don't take from India. One can only hope. But Kulin, all things put together, now I'm going to the bigger picture. I mean, FY25, your top line was up about 8%. Margins, were around 15%. Now, since you're optimistic on the India business, at least Indian demand picking up, UK you're saying could be a big opportunity. What should we expect? How much growth? I mean, can you do at least double digits? And what's the outlook on margins?
Yeah, I think last year, actually, we had an impact of, an industrial unrest in the first quarter of the year, and that impacted FY25 for us. So if you remove that impact and looking at whatever business plan we have where we are focusing on a ramp up of our garments business and significant growth even in our advanced materials business, I think if we add both of those growth drivers, we do expect our growth to go, into the double digits, and we do expect, and a lift in margins as well. I mean, we want our EBITDAs to grow faster than our sales. So we do expect a mid double digit growth in EBITDA.
Okay. And so the margin would then work out to how much better than 15%?
We don't exactly give margin guidance, but I think generally what I can share is we do expect operating leverage to also kick into our business next year.
Got it. So that'll be good news for your shareholders. Quick update on the capex. I think this year you're talking about 450 to 475 crores of capex. Is that all through the internal accruals? And, where will the money be used? Also, just tell us about the additional capacities across your businesses that would be coming on stream this year.
We spent around 470 crores in capex. It was spread 1/3 across our garments, advanced materials, and textiles businesses. And we'll have a similar amount of capex the following year as well. We have seen no increase in our debt levels, so all of this is coming from our internal accruals. And broadly, we've been guiding that our garmenting capacities will see a lift of around 15 to 20%. And we hope to continue to grow our advanced materials business at close to 20%. So these are the two growth drivers which are kind of being pushed with this capex plan.
Garmenting and advanced materials. Got it. So they get another leg up with the additional capex. Kulin, thank you very much for joining in and giving us pretty well-rounded view of course, local operations here and what all these shifting trade winds mean for the business at Arvind. We'll take a break on that note, come back on the other side. We'll wrap up the market action once again and, of course, talk commodities. Manisha will join in. All right, welcome back. So as we've been telling you, equity markets are taking a little easy this morning. Nothing too bad. It's just around the flat line, frankly, for the Nifty and the Bank Nifty. But caps are actually doing quite okay. But let's now shift the focus to commodities. Manisha is here with us in the studios. Manisha, so what's your big headline this Friday morning?
Well, I'm absolutely looking at the gold prices because after being very, very strong and making all those headlines for most part of 2025, we're finally looking at some profit taking coming in. Well, the gold is trading at a 5-week lows. It's headed for a weekly decline of 3%. And this, by the way, is the worst weekly decline that we are looking at in last 6 months coming in for the gold prices. Also, when you look at the prices, the way they have come off, remember $3,500 an ounce was an all-time high. And from those kind of levels, we have seen the gold prices come off by nearly 9 to 10%. The low that the gold market saw yesterday was to the tune of $31.25. It's just about holding $3,200 an ounce in the Asian markets right now. Well, there are various reasons for the gold prices to come off. One, of course, is the tariff de-escalation, which seems to be weighing on to the safe haven buying there. It also is about the Fed rate cut expectations, which seems to be scaling back in sense of time and quantum both. And then it also is about rising U.S. Treasury yields, which is weighing on to the markets right now. The gold is also off highs because we're looking at CFTC data showcasing that many of the net long speculative positions seem to be now winding down. There actually are more shorts being created as well. And why not? Because you've seen the gold prices on a one-way rally from $1,800 an ounce since October 2023 to almost $3,500 on the higher side. So people have been holding those net longs, and we are finally looking at some profit taking there. And speculators cutting their net longs has been on for 5 weeks now since the gold prices hit an all-time high there. They're down by nearly 30% from in the month of April on a month-on-month basis. And from where the net longs stand right now, this is the lowest since Feb 2024. So clearly, a lot of profit taking, a lot of money being pulled back from there. But it's interesting to see on how we've seen trading volumes for the month of April. They have been at a record $181 billion a day there. And also when you look at the ETF buying, well, we've seen 67% of a jump up in the month of April on a month-on-month basis. Well, markets do feel that going forward from here, it's not going to be a very sharp correction. Nobody's talking about 2,500 or 2,000 or going back to those kind of levels. That is because the U.S. chaotic tariff policies perhaps would just about continue. It also is about central bank buying. Every time you see the gold prices coming off, you will see those central bank buyings. And then portfolio diversification, inflation concerns, especially because of tariff, and especially in US, will support gold prices there. The global ETFs is something that you should be keeping an eye on. As I told you, the ETF buying for the month of April jumped up by 67% on a month-on-month basis. For the month of April, it has been the highest since March 2022 at around $11 billion. This is a global number there. But when you look at the Asian markets, and this is where the maximum ETF buying came in at around nearly $7.3 billion, which is the strongest on record. So while the speculators are taking money off, it is the retailers, investors, HNIs and ETF buying which seems to be supporting gold.
Okay, all right, got that. Manisha, thank you very much. So gold in sharp focus. We need to take a very quick break, but do stay on because on the other side, we're getting you a special segment of Indianomics. Lata speaks with Mitul Kotecha of Barclays and Louis Kugis of S&P Global Ratings on the impact of the US-China deal.